Well, hi, ladies and gentlemen. My name is Chris Weston. I'm head of research here at Pepperstone. I'm going to be going through the gold market today, the silver market. Let's have a look at what's going on there. I want to take a specific focus on what's happening in US Treasuries, bond markets, rate markets. They're just so important to the thesis that is gold at the moment. Equity markets, have a quick look at that. And, we've seen a nice breakout in the crude price, which I think is also linked to what we're seeing there as well. Now, we came into the beginning of the year thinking that we were going to see high volatility, but there is some great trends taking place, some great movement taking place under the surface. There's a lot of uncertainty at the moment, a lot of flow type activities that are taking place. I think it's really important to go through them. So let's have a quick look at what we're seeing to get you set. Let's have a look at US 2-year treasuries. We don't see a huge amount of business in these, in the ETFs that we offer here. But it is so important, and it really highlights just the expectations of what central banks are going to be doing. It's not just the Fed, even though they are the world's price maker. The RBA, there's a debate whether they're going to hike in May. There's a 50-50 chance there at a time when there's going to be an election. Really interesting stuff there for our Aussie-centric sort of focused clients. You can go into what's happening in the UK. They're expecting another rate hike in the February meeting there as well. Obviously, there's a lot of political dramas that are going on in the UK. The Canadians are expected to raise rates at the meeting on the 26th of January. We've got a CPI number in the print ahead, and they're potentially going to go out and do quantitative tightening or passive balance sheet runoff before the Federal Reserve. And that's why a lot of people are fairly comfortable with owning CAD exposures, not just because what the crude price does for their terms of trade, but have a look at the US markets, because so much of the world is centered on what's happening in US Fed policy. Have a look at 2-year treasuries, which obviously can capture a lot more of the short-term rate expectations coming through. They were trading around 20 basis points back in September. They're now trading at 105. So, of course, that's a material move that's been playing through in the market there. 10-year treasuries, they've broken out the highest level for a while. People are selling duration there, and people are shorting that. Long end rates have started moving up now. We've started to see signs of a steeper curve. The Fed will love that. They do not want to be raising rates in a flatter curve. Nothing ever good comes in that scenario. But what's important here for the equity market, and I think what we're starting to see is certainly the idea that duration assets are really struggling with the fact that the discount factor has been moving up. So you can see the S&P here. You can see that the rate of change has been moving to the downside. I really like that as a momentum indicator. The RSI, is moving to the bottom end of its range now, but that shows just momentum, obviously, to the downside. And we can see where it sits in its Bollinger Band is trading at the bottom end there as it starts to bear trend. So that's been a really interesting one. We can see now we've broken these series of higher highs. Higher low, should we say, and we've broken through there. We're testing the 100-day moving average as we speak at the moment. Obviously, that's contained a lot of the selling that we saw throughout these periods. So I think we get a break of the 100-day moving average in the S&P. Then we come to the lower of the Dolchin band. Now, I think that's really important because a lot of CTAs or commodity trading advisors or trend following systematic guys will use this 65-day look back period as trailing stop. So if we start trading into the bottom end of that range, will that be defended? Obviously, we have to see, but I think this is something that we could see this trading down to 4,500. The important thing here is that the equity risk premium is changing in the market. There's less of a cushion against valuation for stocks. So if you've got obviously a very high valuation, if you're producing cash flow but you're not paying a dividend, these stocks are getting flogged because effectively the discount factor is moving higher, and therefore the net present value for a lot of these investments is falling. So we're going into sort of classic finance 101 that you're taught at university, but effectively the equity risk premium is offering less of a cushion now under a rising rates environment. And that's why it's so important. But it also has implications for FX markets. The dollar's fighting a mojo, and it also has an impact for gold markets as well. Now, what I want to have a look at is my thesis for what's happening in gold. This is so important. So we're not just talking about this rise in nominal treasury rates. We are talking about a rise in real treasury rates. And these are treasuries that are adjusted for inflation expectations. And traditionally, you'd see them moving very closely inversely. So if real rates are going higher, then gold price is going lower. Gold doesn't have a yield. So when the yield that you're getting on a real basis, of inflation adjusted basis, is becoming less negative, gold is becoming just that little bit less attractive. And what we're actually seeing since the start of the year is a really interesting dynamic where the real rates are moving very, very, very sharply higher. They've gone from negative 112 basis points to negative 61. That's a material move in every capacity. But look at the gold price. It's holding in really, really well. Now, that's got to tell you something. Let's have a look at the rates market. And I've gone to TradingView, and I want to have a look at how I calculate this, because I think this is everyone can do this at home. And what I've done is I've used the Fed funds future. All right, so it's a tradable market that people can express a view in the underlying market. This is not my view. This is the view of the market. And what I've done is I've just simply used this equation here to understand what's being priced into the Fed funds future for March. So you can take a look at that and replicate that for yourself. For those people out there who are using TradingView, and Pepperstone will be there very soon. But you can see that we've basically got 22 basis points of hikes being priced in for March. So if you divide that by 25, which gives you the probability of a rate hike there, because central banks tend to raise rates by 25, although I think some of them will probably start with 10 in these early echelons. And what we can see is 22 basis points. This was about 80-90% chance of a rate hike there. You can see for the June meeting, we've got nearly over 2 rate hikes being priced in then. The market's expecting quantitative tightening to really be talked up in that meeting. And then the idea of 81 basis points, nearly 3 rate hikes being priced in for the September meeting, and then for the December meeting by the end of the year, over 4 rate hikes at 106 basis points. So the market is saying, yeah, we're going to see 4 rate hikes, nearly 5 rate hikes, or more than 4 rate hikes for this year, at a time when they can concurrently allowing their balance sheet to run off passively by not reinvesting the proceeds for maturing US Treasuries and mortgage-backed securities. What does that mean in a market which has generally been driven by a supply side shock that has caused that? Now, there's been demand, of course, but a lot of this has been driven by what's been happening in supply side shocks that's caused this 7% US inflation. Does rates being put up by that aggressive amount and balance sheet runoff, which is causing liquidity to fall in markets at a time when the cost of capital is going up, does that mean that we're closer towards a policy mistake? I think what you're seeing in the gold market and what it's broken away from real rates, which should suggest that gold prices should be getting absolutely hammered on the back of that. I think the market's saying, look, gold is not an inflation hedge at the moment. Gold is a hedge against a policy mistake. And the idea that if rates come out of the market, if the central banks have to backtrack, then gold is going to absolutely fly. So if bond yields start turning, if real rates start turning, this hedge that you've got in your portfolio against a policy mistake that the potential some of this rate hikes have to come out of the portfolio is going to absolutely fly. So what we're going to have a look at now, first of all, I'm going to have a look at what's going in crude, because crude is absolutely fascinating in its own right. I think this is part of the reason why real rates have been moving up the way they are, because you've got this situation where it's broken out now. People are talking $90 crude. It's not a million miles away from there. Can WTI and Brent prices go up? That's going to be another nail in the coffin for the consumer. This will start acting as a handbrake. Gasoline prices are very expensive now in certain countries. And WTI and Brent prices are moving up. This is going to become more of a headwind as we talk about triple deficits playing through in the crude market, not enough investment. As demand ramps up going forward in a post-Omicron world, we are going to be talking about $100 oil, in my opinion, and I think that's where this is going to sort of feed back into the gold situation. It's feeding into rates pricing. If central banks raise by that amount, do we want a 10% sort of allocation towards gold and silver, for example, in case this scenario doesn't plan out? And I think that's exactly what you're seeing in the market. That's why it's broken away from nominal and real rates. And people are saying, let's have a hedge against a kind of policy mistake. And that's exactly what we're seeing there. But look at that crude price broken out. We're going to be talking about this. Looks such a good one for momentum traders at the moment in this market. Now let's have a look at the gold price and just see how this is trading. I'm going to flick this over to a weekly chart, because weekly is absolutely key to give me sort of overview and oversight about what's actually happening here. And my system's running a little bit slow, so it's taken a while. But you can see this kind of really nice sort of cup and handle. I'm not going to go back any further than that, but you can see this kind of really nice sort of feed, this loop into what is effectively a broadening megaphone pattern on the weekly. So you can see we're making these series of lower highs playing through. We need to break 1854, 1850 if we take it down. I think if we were to get that situation, then we're going to start trending. That's going to be a very powerful situation. So 1850, if we're to get there in the weeks ahead, I think that's where we're going to start seeing it bull trend going forward. Let's take this in, and again, you can see just this swing. I want to take this into a daily chart, actually. And while that's still a sort of a longer time sort of swing traders paradise, position traders paradise, you can see here just what we're looking at. This 1830 level clearly is a ceiling on the market. That needs to break there, and then we get to go on to test this downtrend that's been in place. So we might see a bit of supply, But if we were to see this thesis that the market's saying that we're really running this idea of a policy mistake and we need a hedge against that, then I think gold will continue to be in demand. The thing that's holding it back now is that we are starting to see a rising US dollar again, and that's sort of weighing into this. But what we want to see is gold rallying in every currency. If it's rallying in every currency, we know it's people looking for gold per se, and it's not having that currency effect. Now, how do we get that? We get through this 1830 level, 1850, and then it continues to go on. The CTAs, the trend following funds, will start drip feeding length in that. Where do we turn a little bit more bullish? Where do I turn a little bit more bullish? I think if we were to see a close through 1786, we saw this nice swing there. That's the obvious level. We break through back into these sort of 1760 levels. Maybe short positions I'll be looking at taking through on a close here. Let's see what happens for a move back into these kind of lows. I think that's going to be really important. But I do favour, given what I'm seeing from the fact that real rates are telling us a message that gold should be trading much lower than where it is at the moment, but it's held on, and that's got to be saying about the underlying demand that we've been seeing there. So I really like this idea of, a close above 1830. I'm going to drip feed length into that situation, look for markets and see how they react into 1850. If we get a close above that, then I'll just start adding again into that long position for a trend or sort of a positioning kind of situation playing through. Have a look at what we're seeing in some of the other currencies. The yen's been okay, but you can see we've got this kind of rally that's been taking place here. We've got this consolidation here. We've got this kind of this triangle pattern playing through. These, generally speaking, are great for momentum traders who are just seeing the fact that we've had this big move up. We're seeing lower highs. We're also seeing this kind of series of higher lows, and we're seeing lower highs playing through. And effectively, this should, in theory, there's probably about 75-80% probability this breaks the upside. And, we want to see a situation where gold in yen terms breaks out there as well. Have a look at gold in Aussie dollar terms, because this is sort of going sideways at the moment. It feels like this wants to crack up. And if the Aussie dollar weakens some more, maybe because risk comes out of the market, we could see a situation where this continues to go up. That's another one. This feels like a coiled spring that's ready to just absolutely go through. So I think if we're going to get for a move through 25.25, that could be an interesting trade in itself. Now have a look at silver. Silver for me is the place to be. Now, what we've seen, as you can see here, I'm just going to remove these fibs. Actually, let's leave them there. We can see that there's been a bit of a ceiling here. We saw it engulfing, bullish engulfing playing through in last night's session. So we made a new low. Markets have bought that in there. We've closed obviously firmly above this recent price range. What we want to see now is we see a situation where this kicks up. If we can see follow through buying playing through, I'm going to be looking to go long silver in this situation. Now I've got an extension because I think we could probably, if we were to see an extension with a target, we'd be looking for is up at 24.50. So that does give you a good risk reward if we're putting stops below 22.78 and just below this level here where all these people would be wrong. But the moving averages are all aligned. They're moving in the right place. We go above a 50-day moving average, which we could use as a trend filter. We want to see this kick on back above these highs to see follow through from the engulfing. And I think we'll run the risk or an elevated probability that we go through into 24.50. This is something we are looking for going forward. Now, I think, again, just the thesis that we're looking for is we're watching these rates markets. We're watching bond markets. They're rich at the moment. I'm struggling to understand what's going to cause more rates to be priced in. We get the next CPI print in the US not coming till sort of early February, but we do have other central banks we're watching the Bank of Canada, watching the Bank of England, watching obviously what's happening in Australia as well. Will the RBA flip at some stage? And obviously we're watching currency markets very closely at the moment. But my thesis remains the shape of what we're seeing in the gold price, what we're seeing, the failure to react to this move in real rates. It's telling you that if we were to see, a market really believe that we are going to see a policy mistake, that the gold market is going to fly. And I think that could be where we start seeing the next bull market coming through in gold. So I wish you all well. If you like what you heard, hit the like button. I've said some punchy views. I'm sure a lot of people will completely disagree with me. But my theory is that we're using this as a policy mistake hedge rather than an inflation hedge. So I'm keen to see your views. Do run them in the comment section if you see them below. I bid you farewell, and I'll see you next week. I'm Chris Weston.